For more on the markets, let's bring in Ed Yardeni, president of Yardeni Research. Ed, good to see you this morning. And you've been steadfast. I haven't seen you really waffle at all. You've acknowledged we may see some choppiness. And I've seen some funny things. You know, some of the strategists that come on the show. I think we had one on recently that was just talking about the chaos, and that there was tariffs, and Trump inherited this great economy, and now there's chaos, and we're less than a point off an all-time high and most of the averages, and so it's almost as if now it could happen any day. Valuations are stretched, inflation is not put to bed, but why are you so sanguine about reaching, new heights this year to even 7,000, which would be a pretty good move? What is that about? What's that, between 15 and 20%?
Sure. Well, look, it's really all about the resilience of the economy. It just demonstrated over the past 3 years that it could withstand a dramatic tightening of monetary policy. The federal funds rate went from 0 to 5.25%, 5.5%, and just about everybody thought that would cause a recession. I didn't think so. And now what's interesting is that nobody seems to have learned from the experience of the past 3 years that this economy really is resilient. And I think it can take some chaos in policy making and tariff making. And I think by the end of the day, anyways, I think what this administration is aiming for is what they said, not retaliatory tariffs, but reciprocal tariffs. And what that means is we'll match the tariffs of other countries, and then we'll sit down with them after postponing it for 30 days and try to work out lowering of the tariffs. So I think that's important. I think deregulation is an ongoing phenomenon. Look, at the end of the day, it's really all about the resilience of the economy, the strength of the economy, which means that earnings are going to continue to be strong. And that's what I think is driving the market. I think that's what's holding up the market right now.
That's what we need, because we know that stretched multiples in the past, in and of themselves, don't cause the market to come down. So
correct.
I don't know whether we get any expansion. We'd like some rate cuts to get multiple expansion. But even if we're stuck here, if the Fed does nothing this year, there's no reason to think necessarily that something pops in terms of valuation. So if you're right about economic conditions and earnings, you could get your 15% on the S&P purely from business doing well.
Absolutely. And I think productivity has been making a comeback. I think it continues to do so. And I think the technology revolution, the digital revolution, which really started with IBM mainframes in the 1950s and now has evolved to AI technologies. Look, some of them are silly and some of them are not going to suffer from hallucinations. But I think what we're starting to see is a lot of anecdotal evidence that AI technologies, digital technologies, have advanced to the point where they make humanoid robotics and self-driving cars a reality here. Not years from now, but this year, next year. So I think all that put that all together, and you get the market looking solidly forward.
We were talking about this journal piece about signs of froth, and maybe some of it is in the retail investors. I don't know who is the consensus or the people I want to bet against. Sometimes I think it's the pros. The pros have no idea. Sometimes I think it's good to bet against them. Sometimes I think poor retail investors are, out at the bottom, totally in at the top. Correct. So I don't know whether to use this as a contrarian sign or not. Do you see froth or just the market being at a level that isn't justified by the underlying fundamentals?
Well, I think it goes back to what you said about valuation multiples. There is this reversion to the mean factor where a lot of people believe that once you get well above the mean, and everybody seems to take the average of history, and the average of history says the mean forward PE should be around 15. And now for the Magnificent Seven, it's more like 30. I think it's actually down a couple of points from there, from maybe 28. And then for the rest of the market, the S&P 493, it's more like 19. Yeah, sure, those are stretched relative to 15. But the key point on valuation is, as you said, is how long is this expansion going to last? And the past 3 years demonstrate the resilience of the economy, suggesting that there may not be a recession between now and the end of the decade. It may turn out to be the roaring 2020s after all. I mean, we're halfway through it, and so far it certainly looks that way. And there's no particular reason not to believe that a recession is going to happen. If that's the case, then there's plenty of time for earnings to grow and for valuation multiples to become less stretched, not because they take a dive on a recession, but because earnings that are delivered are great.
Have we ever had a 6, 7, 8 year period without a recession? That would be unprecedented. When was the last recession?
The 1990s immediately come to mind. I mean, we had a long period. We had a very long expansion there, and there are a lot of similarities. I've been making the similarities between now and the 1920s. I've been calling it the roaring 2020s, but there are similarities to the 1990s, the technology revolution, and I think we may actually get some fiscal discipline, believe it or not, out of all this chaos. Very reminiscent of what happened with Clinton. Clinton realized that the bond vigilantes limited what he could do. And I think Scott Bessent has been telling Trump that forget about the Fed, look at the bond market. We need to convince the bond market that our policies are going to work.